some type of pouring money into hole type of project, then we do have 2,710 gold pieces worth of wealth. And I really want to stress this point. Remember, gold isn't wealth in of itself. Gold is used to represent wealth. You cannot eat gold. You cannot live under gold. Gold will not transport you someplace. Gold, it will not improve your health. It's something that is used to represent wealth. Sometimes people think it is wealth itself, and that's actually a misconception. So, this 2,710 perceived gold pieces, that does represent real wealth, although it doesn't represent real gold pieces. And this is, and once again, you might say, oh boy, this is some type of a shell game, but it's really not, as long as these investments are good investments. Remember, these are wealth-generating investments. And notice, the money supply, at least as we defined it with this M1, it expanded to facilitate real economic production. So as long as this factory does generate wealth, or this irrigation ditch does generate wealth, then the money supply did not grow faster than the amount of wealth out there. And so a gold piece, if before a gold piece bought an apple, now hopefully a gold piece will still buy an apple. In fact, and this is an important thing to realize, if these investments are very good, you're actually going to have, let's say that, let's say we used to produce 1,000 apples per year. 1,000 apples per year. And notice, apples are real wealth. Apples are something that you can consume, that they will keep you living. And you could also view them as a form of investment, because by eating them, you're able to do work. But anyway, let's say before all of this investment started happening, our economy could produce 1,000 apples. Now let's say that after this irrigation ditch was produced, instead of 1,000 apples, now we go from being able to produce 1,000 apples to being able to produce, 2,000 apples a year. And once again, a lot of wealth was created. Remember, we only took 900 gold pieces to build this, and all of a sudden we're doubling. We're able to produce another incremental 1,000 apples a year, which in our old economy was worth 1,000 gold pieces. So that actually will definitely pay off, right? You borrowed 900 gold pieces, and this project will generate not 1,000 gold pieces in total. It'll actually generate the equivalent of 1,000 gold pieces per year. It increases our production of 1,000 apples per year. And likewise, let's say that this takes us from 2,000, this factory, it takes us from 2,000 apples a year to 3,000. So let's think about it. Now, in a given year, how many apples are being produced? We used to only have 1,000 apples being produced. Now we have 3,000 apples being produced, because these were really good investments. They really improved our productivity. So now if you say, well, everyone in the economy thinks that they have 2,710 gold pieces, or some equivalent of them, and we can produce 3,000 apples, now the money supply, 2,710, actually grew slower than our wealth, right? Maybe I should draw that, but let me draw that out. Before, let's say money, wealth. And I think it's really important to separate the two concepts. Money is used to transact wealth or represent wealth. It is not wealth in and of itself. And that has some important philosophical underpinnings to it. It'll probably make you live happier if you realize this difference. But before, we had 1,000 gold pieces, before the banking and this fractional reserve system existed, and we had 1,000 apples of wealth per year. Right? And I'll go more into the velocity money. But after all of this stuff happened, later, we had 2,710 perceived gold pieces. This was our M1 definition. Our M0, the actual physical gold, was still 1,000. But how many apples do we produce a year? We now produce 3,000 apples. So notice the ratio of gold to apples has actually improved. And now, if you think about it, an apple is actually going to cost less gold. Before, you roughly had 1 gold piece per apple. Now you have less than 1 gold piece per apple. So because of our innovation, we actually experienced deflation. So you might have said, oh boy, all of this money was created out of nowhere. This money doesn't exist. This will lead to inflation. But no, because, and this is a very important point, because the money was put to work in actual productive investments that create wealth, that make the pie bigger, or the the pie of apples bigger, we actually experienced deflation, and our economy actually grew. And this was actually a very, very positive example. I'll see you in the next video.
All right. Now, family, this information should definitely inspire you guys. Not only should it inspire you, it should put you in a capacity where you really understand how these things really fall into play. And the reason why they should do that is because you have to keep in mind of just all the various different things that are going with this. See, the entire banking structure has been put in motion because we watched as the economy kind of digressed into a lot of different things. We have watched as those that have been at the helm, there was no true forensic accounting that was actually being done by the consumer, only because they didn't know. And so I felt more compelled than others to kind of say, well, what if they were given a choice, an opportunity? And so this is where we are today. We talk about current expected credit loss because these are the new accounting standards that's going to be affecting the bank. And I want you to really get the gist of why these things are so important. They're important because if we literally take an accountability the various different things that are being utilized, we'll see that the information that's before us is really designed to kind of put us in a frame of mind where we can really overcome a lot of things. Now, I'm actually start out by coming across from this particular example that I use in a lot of different classes that I teach, across the board. Which again, for those you don't know, my name is Bezel Bay, aka those of you that know WTDTA Radio, J Dog, aka Bezel Bay. I want you to actually understand that under Bezel Bay and Associates, we have been working with recapture recovery for a little over 10 years, back when we had a diverse money channel. And those entrepreneurs that have gone on to do great things pay homage to that particular platform. So we're going to talk about the perfection of the security interest in the United States federal income tax refunds for a reason. Because in order for you to know where you're going, you got to know where you came from. So you got to understand this from the right perspective. All right, listen to this. From time to time, businesses anticipate receiving large federal income tax refunds, when such a situation arises, there may be a desire to borrow against the proposed refund in order to access the anticipated funds more quickly than they would otherwise be available. Well, secured lenders may also wish to perfect a security interest in future federal income tax refunds to further collateralize existing loans secured by assets of a borrower. See, both sides to the loan transaction may therefore be interested in the method to create and perfect a security interest in a federal income tax refund. Number one, the execution of a security agreement describing the collateral. Article 9 of the Uniform Commercial Code governs security interest in most types of personal property. Because Article 9 does not expressly exclude federal income tax refunds from its scope, the grant of a security interest in a federal income tax refund is subject to the provisions of Article 9. And when you look at Article 9, Title 6, subsection under the Uniform Commercial Code 9-109, subsection 8, it states, because no section of Article 9 expressly discusses federal income tax refunds, such refunds are deemed to be general intangibles. So on your ledger, if you utilize general intangibles, you're actually able to put this in the right perspective. And this actually can be done under Title 6, subsection 9-102, subsection 842. To create a security interest in general intangibles such as federal income tax refund, a borrower must grant a lender a security interest through a security agreement or similar instrument. Let me say that again. To create a security interest in a general intangible such as a federal income tax refund, a borrower must grant a lender a security interest through a security agreement or similar instrument. See, under the Delaware Code Annex Title 6, subsection 9, 203, a security interest is enforceable with respect to specific collateral against the borrower and third parties when A, a value has been given, i.e. a loan has been made, and B, the borrower has rights in the collateral or the power to transfer the collateral, and C, the borrower has executed a security agreement or similar instrument that describes the collateral. See, the security agreement and or the UCC1 the UCC1 financing statement to be filed in connection with it. In other words, you're going to do a security agreement and use a UCC financing statement. That's going to be filed in the conjunction, and it must describe the collateral in reasonable detail. See, this is actually under Delaware Code Annex Title 6, subsection 9-108, subsection A. Though a description such as all general intangible is likely sufficient, a reference to the specific federal income tax refund in question, or at least a reference to all federal income tax refunds, might be preferable for both the borrower and lender. So in other words, if you want to be clear, then just put all federal income taxes after you list the all general intangibles. You say all general intangibles, then you draw a line and say all federal income tax refunds. That way you got both sides. And then we come to the second part of this. We talk about the execution of the IRS and the DOT forms. And the DOT in this scenario means Department of Treasury. The execution and delivery of a security agreement coupled with the filing of a financial statement creates and perfects a lender's security interest in many types of personal property. And in the case of federal income tax refunds, however, additional steps are necessary to allow the lender to obtain payment of the federal income tax refunds directly from the Internal Revenue Service, or what we call the IRS. In addition to the security agreement discussed above, and the UCC1 financing statement described below, a lender should also prepare and have the borrower execute the following IRS forms. See, under subsection A, Form 2848, which is the power of attorney form, and Form 8302, which is the electronic deposit of tax refund of $1 million or more. See, which is the Form 8302. Then you also have Form 2840, which allows the individual other than the borrower to obtain a federal income tax refund on behalf of the borrower. You got Part 1, subsection 6 of Form 2848 requires the name of an authorized representative who will receive the federal income tax refund instead of the borrower. See, Form 2848 does not by itself authorize the authorized representative to endorse or cash the federal income tax refund. That requires an additional Department of Treasury form described below. For the purposes of preparing the Form 2848, the person named as the authorized representative must either be an attorney, or, that's number A, B, a certified public accountant, or C, an enrolled agent, as defined in the Treasury Department Circular number 230. In order for the IRS to process Form 2848 quickly, the person listed as the authorized representative should be an individual that has already received what is known as a centralized authorization file, or what we call a CAF number, a CAF number from the Internal Revenue Service. If there is no such person, the IRS will assign a CAF number to the individual listed as the authorized representative. Form 2848 should be faxed to the appropriate CAF service center. In cases where the lender expects that the federal income tax refund will equal $1 million or more, the lender should require the borrower to execute Form 8302, authorizing the IRS to wire the proceeds of the federal income tax refund to an account maintained by the lender for the benefit of the borrower, i.e. an account for the borrower that is located at the lender's financial institution. See, Form 8302 should be filed with the borrower's tax return, if possible. Otherwise, Form 8302 should be mailed to the same IRS address where the borrower files its annual tax return. In addition to the IRS forms referenced above, the borrower must also execute the following Department of Treasury forms. See, Form 235, which is a resolution by the corporation conferring authority upon an officer to execute a power of attorney for the collections of checks drawn on the United States Treasury. And